First, I'd like to thank you all for coming tonight. My name is Stephanie Mauro. I am the owner and founder of College Planning 101. I started my business in November of '09, and my bio is on the back of the Develop a College Plan, so you can read that at your leisure. So, what are we going to learn today? Well, I always like to start my presentations with today's college costs. It is always an eye-opener for those who have never really looked at the total cost of attendance. Then we're going to talk about what does 4 years really cost. A lot of families can't get past year one, but I want to bring to your attention that it is at least a 4-year deal. So we'll look at that. Then we'll talk about the expected family contribution, which I will refer to as the EFC. The two different EFC formulas, there's the FAFSA, which is the free application for federal student aid, and then the CSS Profile, which about 400 colleges, maybe 500 at this point, take. Then we'll talk about the assets that increase your EFC, how it affects the cost of college, and how financial need is determined. Then we'll talk about the aid and types of aid that are available. We'll talk about the merit and need-based aid and how it's determined. Merit is separate from need. And then I have 2 case studies, and then we'll go through the student loan evaluation. So 2016-2017, cost of attendance. NYU, 66. And when I talk about cost of attendance, there are actually 5 parts that you should be aware of. You're going to get billed for tuition. You're going to get billed for room and board. You're not going to get billed for books. That's a whole separate. Then there are miscellaneous fees, like the health fee and the athletic fee. And you say, well, my student's not an athlete. Yeah, but everybody pays a little bit. And there are fees. And then there are miscellaneous expenses, like dorm room stuff and shampoo and going out money. So there's a lot to the cost of attendance, and some portions are not billed. Fordham University at 65, Quinnipiac, Marist, Manhattan College, UConn in New York, we pay 50. In Connecticut, you pay 30. And then I have New York State schools. You can see you guys would pay 30 in the 30s, we pay in the 20s. And then CUNY Lehman, 10 and 20,000, that's actually only their tuition. Their room and board is unique because they don't have housing. Some of the CUNYs do. That's the City Universities of New York. So if your student is interested in the CUNY system, it can be cost effective even for an out-of-state resident, but you do have to be aware of the costs associated with rooming. And if your student only has, one roommate, it's going to be more expensive than if they have, 3 or 4 roommates. Any surprises? And this is why it's so important that our students graduate in 4 years. Because at the end of 4 years, the costs are astronomical. Now, this is in your packet as well, but it's pretty clear up here. So when we're looking at the cost of attendance, and we're looking at, in this case, a SUNY or a state school, every year, the cost of attendance goes up. So I use a 6% increase year over year. In my 9 years of doing this, I've seen a cost of attendance go up at 2 or 3% and as much as 6 to 8%. So I feel that when I'm doing the projection, a 6% cost of attendance increase is a sufficient number. I hope I'm wrong too. I hope it's less, but I've seen it go up more than 6%. So with a SUNY, at the cost of attendance being 22,000, really, merit and need-based aid is not provided to a lot of students. You got to be in like the top 10% of the incoming freshman class, and you've got to be super, poor, if you will. Definitely under $70,000 of income and very little assets in order to see any type of need-based money from a SUNY. And every college actually provides need at a different level. So I have some SUNYs that actually will provide 80% of need, like the SUNY Potsdam, for example, 80%. I'm not sure what UConn does, but I think UConn is like in the 50% range. And then you have colleges like Syracuse University that meet, on average, 96% of need. And of course, all the Ivies, they only meet need at 100%. I don't know what NYU does. I'm not sure. They're not very generous. You've probably experienced that. So as you can see, year over year, at a $22,000 a year cost, at the end of 4 years, it could be as much as $26,000. And today, Binghamton is $25,000, so that's probably going to be closer to $30,000 at the end of 4 years. And even at the most cost-effective option in New York, our state schools, it's still $96,000 a year to go to college. I mean, over 4 years to go to college. So you're still looking at $100,000 of some type of out-of-pocket, whether you have a 529, or you've saved, or you're debting your student up. The Stafford loan, you'll see this piece here, 55, 65, 75, and 75. That is a very good loan to take and start with if you are going to debt your students up for college. So anybody who's going to go into debt, start with the Stafford loan. This year's Stafford loan's interest rate is 5.05% interest. And if your expected family contribution is less than the cost of attendance, you get what's called a subsidized Stafford loan. I don't know if that really applies to this audience, but I will explain it anyway. So when your EFC is lower than the cost of attendance, $3,500 of the $5,500 is interest-free. So the government is paying the interest on that portion of the loan. 45 of the 65 and 55 of the 75. So all but $2,000 is interest-free. So if you started college, if your student started college this year, and you received a subsidized Stafford loan, 5.05% interest is what the current interest rate is for the Stafford loans. And that would only build on the $2,000 balance. Does that make sense to everybody? Am I explaining that clearly? If I am not explaining things clearly, please do stop me for clarification, okay? Then when we get to the private university at $66,000 a year, you may get merit, you may get need, and you can still be out of pocket over $40,000 after taking the Stafford loan and getting, I hope this is off. Sorry, my dad is in the hospital, so I apologize. So when you start putting 6% year over year, at the end of 4 years, a $66,000 college can turn into $78,000. When I started my business in November of '09, a college would be $58,000, $59,000, and we'd be like, oh my God, that's almost $60,000, that's crazy. And now we're looking at colleges that are over $70,000. So the cost, the increases have outpaced, as we all know, our investment performance, the raises we get. And one of the statistics I read was in 2008, when the market crashed, colleges still went up on average 5.8%. And they have to, though. Let's look at it from their perspective. They're running a business. They've got kids taking 5 showers a day. They've got to heat, they've got to cool. They've got to provide all the supplies and the maintenance and the faculty that have unions and get automatic raises every year, no matter what the market's doing. So they do have to pay their bills. And for those of you who have visited colleges, they are beautiful. And they're wonderful places for our students to really start their lives. So there's the, wow, that's expensive. But then when you start to understand the why behind it, you're like, yeah, I get that. So, NYU just came out with, med school for free. They're taking 90 students. If I read the article correctly, I saw 90 students a year. But hey, that's 90 students, but that's going to be the upper echelon. They're not even looking at financials. They're just going to take the creme de la creme, 90 students, and give them free medical school. One of my students is applying to dental school, Tufts. He got into Tufts, yay! Like, yay, $100,000 a year. For 4 years, $400,000 for dental school. Crazy, crazy. And med school is like that too. So we want to be very cognizant of making sure our students graduate in 4 years. The best way to do that is actually 30 credits a year. A bachelor's is 120 credits. One of the main reasons why students are not graduating in 4 years is because they're only doing 12 credits a semester. And that's only 24 credits a year. My students, I tell them, if you can't, some majors are very intense, like pre-med. So you really want to maybe do only 12 credits a semester, but then do 6 credits over the summer. So they're like, wait, I got to do stuff over the summer. I'm like, yeah, get used to it. When you get into the real world, you don't have summers off. So keep your mind going. So keep that in mind. A 4-year bachelor's degree is 120 credits. And then the students get to their senior year and they're 12 credits shy or whatever, and they have to go for a whole other semester. And at the end of 4 years, what's half that semester? Now we have a 5th year. with a possible 6% increase over that. And then there are natural 6-year deals. You got your law degree, you have physical therapy. Siena has a 5-year MBA program, so you get your master's in business administration in 5 years instead of 6. So there are some really great things out there, and then there are some things that are just going to take 6 years, and you know that going in. But for a marketing degree, and even your pre-med, and any other degree that's 4 years, you really want to be cognizant in making sure that the students are doing what they need to do and that their advisors are making sure. But they love that 5th year. There's no FAFSA. They're not considered a graduate student, so there's no graduate benefits. Merit scholarships are no longer, because merit scholarships are only for 4 years. So be cognizant of that in how your student handles their coursework, because at the end of 4 years, $208,000 is a lot of money to spend for an undergraduate degree. So how am I supposed to pay for this? Well, we've got your money, your savings, current income, borrow, children's resources, and the only reason why I have the word retirement up there is to remind me to tell you, don't do that. That retirement is for you. And unless you have $1 million and 10 or 15 years more to work, you really shouldn't be touching your retirement. I've had parents take a home equity line of credit out on their house. That's one way. But still, then it's your debt, and that payment starts right away. The whole point here is to make good decisions before you get to the fact of having to pay for it. And that can start when your student is a baby, saving in that 529 plan, and or making sure that you're not choosing colleges that are so expensive that you are having to debt them up so much. Another thing that happens is the debt to income ratio for some families starts to squeeze, and we'll look at the end of the presentation at the student loan evaluation. And they're very strict about debt to income ratio because they want to make sure you can pay it, because so many students are defaulting, $1.3 trillion in student loan debt. It's a lot of money, and banks are like, wait a minute, you keep defaulting. So they're very cautious about that. The interest rates are high, and they're really looking at the cosigner. And then what happens is you get to junior, senior year, and you say, oh, 40 grand's not bad the first year. Do it the second year. And then you get to the 3rd year, 4th year, and if your income and debt starts to squeeze because you still have your mortgage, you might have other debt against your income, and then the private loans say, we're not going to give you any more money. And you're like, wait, what? You've been giving it to me all along. But you don't qualify now. And it actually happened to my girlfriend, and she said, you said it was going to happen. And in the 4th year, her son she could not co-sign the loan. Could not do it. And thank God he worked really hard over the summer, and he paid for his final year. So you better really be cognizant of that. My favorite way to pay is other people's monies. Gifts from relatives, financial aid, merit aid, educational tax strategies. I do not go through educational tax strategies. I am not a CPA, and they can change at the swipe of a pen by our government. So when your student is in college and you're filing your taxes, please make your accountant or TurboTax program aware that you have a student in college, and they will let you know exactly what's available to you based on your income, because I know a lot of the tax benefits, they kind of zero out with income. Like they have brackets. If you're under 100,000, you get the full amount. 100 to 150 gets a portion, and then over 150 gets nothing. So there are bracketed amounts that you would qualify for. So definitely, if you're using TurboTax, it'll ask you, do you have a student in college? And if you're working for working with an accountant, let them know as well. Gifts from relatives are always nice, but it's rare. So, grandma and grandpa could be saving in the 529. That's excellent. That's another way. And then financial aid is based on your income and assets, and merit aid is based on the fabulousness of your student. So I have a lot of families who are wealthy, and they're like, oh yeah, we don't qualify for anything. I'm like, well, you don't qualify for financial aid. But if your student understands the scores they need, and we position them properly for the right college, merit aid is for any student. Admissions looks at the merit. Financial aid looks at the financials, and they don't really cross over until the student's file is complete, and then they might start talking. But what they love is they love the student who doesn't qualify for need-based aid. They're like, oh, we only have to give them merit? Good, we'll take this kid, because it saves them money. Now they don't have to fill 2 buckets, but a lot of my families who do qualify for need-based money do get both. So I haven't hit the grand slam yet where I had the athletic scholarship, the need-based money, and the merit-based money. That's the grand slam I'm waiting for, but generally they do one or the other on athletics. So the admissions department's like, yeah, you're getting enough on the athletic scholarship. And I've had 5 kids get a full ride, but again, they're a real top student, very poor family. So that's the sweetness. And my brother even said to me, oh, Chris is going to get a full ride. I said, really? In the car? Like, you make over $200,000 a year. To get a free ride, you have to be poor and have a top student. And my brother's like, really? I'm like, well, that's why you hired me, right? Not that he paid, but anyway. Are we clear on this? Everybody clear? Great. So what is the expected family contribution? Well, the EFC is the minimum the government expects you to pay based on your income and assets. And the reason why I say, and non-retirement assets, and the reason why I say government and or college, but the government is where the FAFSA comes from. Free application for federal student aid, that's the federal student aid. So that's what the colleges use to determine need. Okay? There are 2 methods, the federal method and the institutional method. The FAFSA only looks at parent income, non-retirement assets. If a student makes more than $5,000 a year, it starts to impact. Student assets, equity in vacation homes, and equity in investment properties held privately. Does anybody here have investment properties they hold privately? Okay, yes, you hold it privately? So, do you think you qualify for need-based aid? Maybe, maybe not. When you have an investment property held privately, there are 2 problems with that. They count on the FAFSA, and should anything happen to one of your tenants on that property, you could be personally held liable. When you put that property in an S Corp or an LLC, it is off the FAFSA and the corporation gets sued, not the owner. So something to consider. So whenever I have families who work with me, I encourage them to work with their accountant or lawyer to open up the corporation, and then you have to retitle it and you have to go through all that formal paperwork, and then you as an individual are protected, and then it doesn't show up on the FAFSA. Hello. That's okay. I just ask that questions are held until the end, okay? And the complete presentation is in the packet. So the FAFSA, and also the FAFSA is looking at 2 years prior. So it's called, has anybody heard of the words prior? No? So when I first started my business, we would file the FAFSA with the tax return that was complete, and then have to rush and get the taxes return done for the current year, and then update the FAFSA. So everybody said, this is a pain in the neck. I'm a business owner. I don't do my taxes until October, and I'm not finding out anything until January 1st. You know, this is the timing is bad. So what the government said was, okay, we're going to look at 2 years prior tax return, assets currently, so current assets as of the date of the filing of the FAFSA, tax return 2 years prior, no updates required. So this way, if you're a business owner, your taxes are already done because you had to have them done by October 1st. And then the new FAFSA is now available as of October 1st. It's not due, it is available on October 1st. So it's still a little late in the game, because if you do think, like I can have a 5-minute conversation and know whether or not you qualify for need-based aid. And based on that information, if you're not finding out what you qualify for need-based aid until October, well, your students already made a lot of decisions by then on where they want to apply. So you can do the FAFSA forecaster, you can do a lot of stuff online. Just be careful with the information online. It is not always accurate. And every college by law has to have the net price calculator at their website. Yale's is off by $10,000. So I had a client come to me and said, you know, your calculation, and I calculate this for my families and it's accurate. Your calculation said $28,000 to Yale, which by the way is still not a bad price, but I did their net price calculator and it came back at 18. And I said, if you pay 18, I'll refund half your fee. Because I cannot be wrong. You're paying me to be right. So we get the paperwork, pay $28,000, like 27 and change to Yale. We called Yale, we're like, hello, we did the net price calculator at your website. And I happened to get the director of financial aid there, and she said, we are required by law, it doesn't have to be accurate. Her attitude, her curtness, and I know now I'm calling, you know, during the FAFSA filing season, so she's probably tired of people at that point. But I was like, but you're Yale. And then I was talking to the superintendent in my school district. She's like, I went to Yale's, website. I said, oh, 18,000. He goes, how'd you know? I said, it seems like everybody's going to pay 18,000 for Yale. So just be careful with what is on the internet. And if you are going to do these things on your own, you should not have to pay for filing of the FAFSA. Remember, the first F stands for free. So keep that in mind if you decide to do that on your own. So then we get to the institutional methodology, which is the CSS profile. And it starts to look at more things. And this is the Syracuses of the world, the Sacred Hearts, all the Ivies, the Northeasterns. Those are the colleges that take, in addition to this, you have to file the CSS profile. And now they're looking at the parent income, the non-retirement assets, student income, $1,850. Minimum. Dollar for dollar, they add that to the EFC. My student didn't work. We don't care. We assume they're going to make $1,850. Great, thanks. Student assets, sibling assets. But wait, that's my other student's money. And it's in their name, it's in their bank account. I'm not talking about 529s, we'll get to that. We're talking about your second, third, fourth students' bank accounts count on the CSS profile. Assets held by relatives for the student. So when I first started my business, we would use grandma and grandpa, aunts and uncles to do 529s as long as it didn't interfere with their own financial planning. Can't do that anymore when it comes to the CSS profile. Now, yes, you can remove them as a beneficiary and then re-add them as a beneficiary. So there's a little bit of a loophole there. But this question is now 2 years old, or 3 years old. So it's a new question on the CSS profile. And then the equity held in your current home. So see, that's not on there on the FAFSA, but equity in your current home is an asset. And they feel that if you really, if your student says, but I really want to go to Syracuse, you might dip into the equity of your home. They're banking on that. Then equity in vacations home, and then equity in investment properties held privately or in a business and businesses under 100 employees. Everything counts. If you have a business with under 100 employees, it doesn't count on the FAFSA. If you have a business over 100 employees, the FAFSA wants to know about it. I have not worked with a family yet who has a business with over 100 employees. 80 was my top. It's like, good, don't hire anybody else. Okay? So there's a lot more to the CSS profile expected family contribution than to the FAFSA. There are certain families I will actually steer away from CSS profile colleges because they're not going to qualify for need where they would with the FAFSA. And I'll, of course, I talk to the student, any of these colleges that require the CSS, are you really interested in them? And it's usually so early in the game that they're not. And I say, well, if you are, then we know we have to, you have to get the 1600 SAT score so that you get a really good merit scholarship to make it work. And that's why we call it student positioning, because we're always understanding the family's financial condition, the student's capacity, and how we can make that work best for the family. But the CSS profile's EFC is usually higher. And on the CSS profile, we do include the retirement assets, but it does not increase the EFC, okay? And if you own a business, how many here own a business? Anybody? Yeah? So on the CSS, did you fill out the CSS for the NYU, or you just didn't bother?
No, I did for the NYU. Yeah.
And did you have to put in, like, your current receipts?
Remember, you only do it once. You only do it
for NYU, you only do it once, correct?
Right.
And so if you have a business, they want to know your current, like annual gross sales and all of the minutia that goes on in your business, and they want your full business tax return. So you have to enter it in, and then they make you send the full tax return. And some people are like, well, why don't we just not put that? Okay, we can't. Yeah, don't lie. If you lie on the FAFSA, it is a $20,000 fine. And I don't know about the CSS profile, but you probably would, not be accepted anymore, because it's not a federal thing. It goes through the College Board. But the free application for federal student aid, if you get caught lying on that form, there is a $20,000 fine. So don't do that. Not that I think you would, I'm just saying. So what are the assets that increase the EFC? 529, stocks, bonds, mutual funds, CDs, trust accounts, bank accounts, UGMAs, UTMAs. So how many families here think that the 529 belongs to the student? Okay, it is a parent asset, not a student asset. And that is a good thing. The 529 belongs to the parent, and the student is the beneficiary. And that's a good thing, and you'll find out why. The Uniform Gift to Minors Act, Uniform Trust for Minors Act, that is the student's asset. You are the custodian of that. And be careful with those, because at the age of 18, with most of them, it belongs to the student. It's their money. You are no longer the custodian of it. Now, we don't have to tell them that, but it is their money. So that is not my favorite way of saving for college. And the 529s are fantastic. We were talking earlier, there are tax deductions you may qualify for. You have the power of time if you started early. So, trust accounts. I like to see the trust document to see how it's worded. If it says it's for college, we actually have to count whatever money is in that trust for the student. But if it says it's not available to the student until the age of 21 or 25, then we don't count it. So I like to read through the trust document to see the actual verbiage there, so I know if I need to count it or not. And a lot of people say, well, is all this stuff looked at? It's not, but it could be. They could request any document from you. And now, instead of, on the FAFSA, instead of having to input everything, we have to use what's called the data retrieval tool, which connects to the IRS, and then it pulls everything over from the tax return. So it simplified my life, because I wasn't lying. But for those families who, well, maybe we just won't put all that, 8A, what's the 8A? Line 8A is interest income. Yeah, we just won't put that there. Because interest income shows that you have a lot in assets. And that's where people were getting tripped up. They weren't realizing, oh yeah, we're going to put in all our tax stuff, but yeah, I only have, $15,000 in assets. And they'd be like, well, then how do you have $1,000 on line 8A? So that's where it gets kind of tripped up. Or if you're being honest about your assets and you don't put anything in 8A, they'd be like, well, where's line 8A? You have nothing there. Where is this money? If you say you have $100,000 in investments. So people don't understand the nuances of it, and they think they're maybe saving here when they're being honest there. And so the data retrieval tool absorbs all that, everything goes in, and then I assure you that being honest is, of course, the best way to be, right? So, and this is why it's better to have it in your name than the student's name. Parents are only assessed at 5.64% on all assets. So if you have $100,000 in a stock, bond, mutual fund, 529, whatever, that's non-retirement, $5,640 will start the EFC. Income, I've seen it actually at 15%, but the general rule is 20 to 47%. So when we have families who are that $80,000 to $150,000 in income, they're charged at about 20%. Now, what affects it? Why is it 20 to 47%? Number in college. Well, number in college matters, but number in family. So if you have $150,000 of income, but you have 6 family members, they're going to take less of a percentage of your income because you need it for your family. Where if you're a family of 3 and you have $150,000 of income, you might be at the 25%. Does that make sense? So the more you have in your family, the less they're going to take, and the less you have in your family, the more percentage they're going to take. So have more kids. I'm just kidding. Nope. Okay. So if you had $100,000 in income and 4 family members, you'd probably be charged around the 20%. So then your EFC would be $20,000 plus the $5,640 for $100,000 in assets. Am I clear here? So then your EFC would be $25,640. Clear? That's how it is. So it's not like I have $100,000 in assets and that's what my EFC is. They use percentages of 5.64% in non-retirement assets and 20 to 47%. So who gets charged at 47%? People making $300,000 and more. They just like, that's it. So, and I don't even know why they bother with that, because obviously if they're making $300,000, they're not qualified for need. But some formula. So what happens with the students? So the students on the FAFSA get charged 20% on their assets. So if they had $10,000 in their name, $2,000 would be added to the $25,000. Now we're at $27,000 in an EFC. Student profile, the profile, they get charged 25%. And again, if they're making more than $5,000 a year in income, that's when it starts to impact the EFC. And then on the profile, 100% of income, in fact, 100% of 1850 plus. So if they made $2,000, then that would be their income, and it is dollar for dollar on the expected family contribution. So I had a student who got into Brown. Her parents made $105,000 a year. So I knew she was going to get a lot of money. They meet 100% of need. They're an Ivy. I predicted I said to them 10 to 15,000. I said, you know, there are some variations here with the Ivies, and they make up their own numbers. When we file the FAFSA, we actually get a number. Your EFC is this. You file the CSS profile, it goes into a black hole. You don't know what you're going to get. Each college looks at it differently, and the deciding factor is how bad do they want your student. So we filed the non-tax filer form for the student, submitted all the paperwork via iDoc. I don't know if you had to use iDoc for everything. We did everything right. And we got back a $22,000 EFC. I expected it to be in the $10,000 to $15,000 range. And I see that they have student EFC $2,400. I think maybe $2,600. We call, we're like, hello, where'd you get $2,400 for the student? Well, we assumed she was going to make money. I said, well, you assumed incorrectly. I filed the non-tax filer. We put zeros in everything, and she's really not going to work this summer. She is going to continue her education. She's going to do 2 courses over the summer. She's, you know, one of those students who just loves to learn. So you have to reduce that. And we did get it down to $12,000 for the EFC. Yep, we did. Because they really wanted her. If they didn't really want her, they would have been like, that's what we're offering. I said, have you looked at her complete file? So you can negotiate with the colleges. I will tell you that that was now 5 years ago. In the past 3 years, it is what it is. They're not looking at competitive offers anymore. The only reason to get more need-based aid is divorce, loss of income, high medical bills. And it'll tell you that right on their website, or even like in some offer letters, if you're planning to appeal, these are the reasons we accept for appeals. Because when my niece was my first student, November of '09, she started her junior year. I said, come on, we're going to work together. I hope I do this right. So when she was going to Roger Williams, I called and I said, you know, we're negotiating. They're like, appeals are up 300%. We can't even keep up with it. We're just denying everybody. There's no way we're going to get through all of this. So we did get Jamie more money because I said, well, you know, she's Gold Award, she's got AP, and you'll see she's one of my cases. You know, she's a fantastic student. So please don't say no to her. So she went from an $11,000 award to an $18,000 award. She went from having to keep a 3.0 GPA to maintain that award to a 3.3 GPA. So the more she got, the more of a GPA requirement was on her, but that's fine. I said, that's gonna give you an edge in the, you know, when you go out for a job, that you had to maintain this when students who didn't have that, you know, they might have had a 2.9 GPA. or 3.2 for that matter, and you were held at this level. So it can be a benefit, and it can be stressful. But it's better to have assets in your name than in the student's name, and that's the takeaway here. So how does it affect the cost of college? Well, once you go through a very complicated EFC calculation, it's quite easy. It's a quite simple, subtraction formula. Cost of attendance minus EFC is need. Simple. So once you get your EFC number, then resources, some colleges will take away private scholarships dollar for dollar. The Ivies all do, absolutely, because they're 100% need. There are some colleges that will offer higher need, like a Syracuse, and so they may see it as, well, you got that private scholarship, we're going to take that away from your need. PACE, one of my students got the Mark Molinaro Award and got a $6,500 award, and they did not take it off because he did qualify for need and did get a merit scholarship, and they left his need where it was. So it depends on the college, and that can actually change year to year. Last year they might have been really generous, and then they see their endowment got a little dip in it. So now this year they can't be as generous. They have to manage those investments themselves, So in this case, a $12,000 expected family contribution, you'd have $8,000 of need or $43,000 of need, depending on the cost of attendance. And then if the EFC went to $25,000, you can see you have no need here and less need there. Is this clear? So it's always cost of attendance minus the expected family contribution is need. Clear, sir? Clear? Okay, excellent. So how much aid is out there and where and how do I get it? Well, the biggest area is the federal loan program. You have the Stafford loan, which is a strong loan program I recommend if you're going to debt your student up. You have the Parent Plus loan, which is another lower interest loan, but it is your debt, not your student's debt. So be careful of that. You have the Grad Plus loans as well. So once your student has a 4-year degree and they go to grad school, they can then do their own FAFSA. And they'll get a $20,500 Stafford loan, unsubsidized, so it's all interest building on the whole amount, but it's still a nice chunk of change for grad school under the Stafford loan program. And then the Grad Plus loans are also a better loan program. Okay, so that's where the federal loans are the biggest. The next line, the institutional grants, that's what so many families leave on the table, because they don't understand the positioning of their student. They don't think they qualify for need, and they really do, depending on the college. Like if you're at $125,000 to $150,000 of need, you're not qualified for need at a state school. But at the $70,000 school, you are. And if you have a lot of equity in your home and you have a lot of assets, then there has to be some calculations done. But that 150 mark is like that magic number of qualifying on the higher end college, on the more expensive colleges, where in your state schools, you're not going to qualify. Does that make sense to everybody? So the magic number on income is like 150. If you're making 150 or less, you might qualify for need at a very expensive, the $60,000, $70,000, even a $50,000 a year school. If you have a lot of equity in your home and a lot of liquid non-retirement assets, then you might not qualify as much. But if you don't have equity, a lot of equity in your home, and again, if they are taking the CSS profile, if they're not taking the CSS profile and they're only looking at your income, you definitely will qualify for need-based aid if you're at the 150 or lower on the $50,000, $60,000, $70,000. Okay, because then your EFC is not as high.
For
that,
university, you mean 79,000?
I'm sorry?
When you pay 79,000 for a university.
Right, the 50, 60, 70,000. When you're into the 40, 30, and 20s, then you're generally not qualifying for need at 150. So that I find in my practice is that magic number and that defining line. Over that, then we start coming out of the need. Okay? So the institutional grants are the merit-based money. Again, merit is based on the fabulousness of your student, their SAT scores, their GPA, their extracurriculars. Volunteering is huge, huge. And students are like, oh yeah, I'm going to join this club and that club. I'm like, no, just join the clubs that mean something to you. I want my students to be true to themselves, but I do want them to be involved. Boy Scouts, Girl Scouts, huge. So there's a lot of great things that our students can be doing, musical, athletic talents, all of that. You know, and students are like, well, I'm not a D1. Okay, fine. You know, I've had many D3 coaches give my students more merit aid. And then if they don't want to play anymore, merit is still merit. So they still keep that as long as they maintain the GPA. So I like D3 schools for that reason, actually. And I had Misericordia ask one of my students to get 50 more points on his SAT, March of senior year, and they'll give him $8,000 more. He wrote it in a text. We had it in writing. He got 90 points more, and he did get the $8,000 in March of senior year. So anything is possible. That's rare. Generally, you know, what you apply with is what you're working with. But the SATs, ACTs are where the merit money is. Most colleges admit by GPA and give merit scholarships based on the student, but it starts with the SAT or ACT scores. And I have clients who, you know, went to various colleges that their students are looking at now. They're like, I wouldn't get in with my SAT scores or GPA. Every year it seems to go up just a little bit. They're looking, it's very competitive. Tens of thousands of students are applying to college. It's since 2007 to current, it is the largest application pools in the history of America because we as parents know the importance of it. And in today's world, a 4-year degree, while is important, it's kind of like everybody's got that now. So it's that master's degree, but I always encourage my students, get your 4-year degree, get a job, and see if your employer will pay for your master's. And this online education makes it very, very convenient to work full-time and get your master's. So we really have to be creative in how we handle those last 2 years, because that's where a lot of the debt can be incurred. So federal Pell Grants are for very poor people. Private loans we'll talk about later. Educational tax benefits we touched upon. State grants. I don't think Connecticut has a state grant. I'm not too sure. I meant to look that up, but I got busy today hanging out in Danbury Hospital with my dad, and that was one of my tasks for today. I'm not sure. Do you guys know if you have a state grant here? Because in New York we have the tuition assistance program.
I think maybe, yeah.
So the tuition assistance program is TAP, and if families make like under $70,000, then they qualify for that, and it's like income based. And then then we have the Excelsior Scholarship in New York, which is a whole other ball of wax I won't go into here. But state grants, I know Vermont has a state grant. There are other federal programs, and then campus-based work study is nice, but they always take it off the cost of attendance. So here's your $50,000 school, you got $10,000 in merit, you're taking the $5,500 Stafford loan, and here's $2,000 in work study. And then you see that in final numbers, like, oh wow, they're taking that off. Like, but they're not going to take that off of your cost of attendance. Your student actually has to go in, get the job, and work. And you will never see that money, ever, because that's their spending money. So we want to be cognizant of the work study is something that you should not take off the cost of attendance, and your students should not work first semester. They need time to acclimate and get their feet wet on campus and get comfortable, and then second semester and then sophomore year they could work if it works for them. Okay? So there are 2 types of aid. We talked about merit based on grades, GPA, class rank, extracurriculars, athletic and musical talents. I had a student get $4,000 to be in Sacred Heart's marching band. I have many students, getting scholarships because they're applying to a music program, and they go in and they do their auditions, and their auditions are so strong they get a merit scholarship for that. And then need, we talked about family income, assets, number in college. So if your expected family contribution is $50,000, that's per family. Once you have 2 students in college, it cuts it in half and it becomes $25,000 per student. And if you have 3, it gets divided into thirds. I have 2 clients now with 3 students in college. I know.
With these numbers.
It's crazy. Crazy. So just keep that in mind. And other factors like age of the older parent. So there's what's called the asset protection allowance. And the asset protection allowance says if you have $100,000 in assets, well, we're gonna say that 20,000 of it's protected. So then that 5.64% I was talking about earlier would only be on $80,000. Does that make sense? Asset protection allowance is the government saying, okay, we're not going to count all of your money. Based on number of people in your family and the age of the older parent, we're going to determine that $15,000, $20,000, $25,000 is your protected asset. And then the 5.6% gets calculated over that. Understood? Okay. So, belief systems. There is no aid for middle-class families, and that's absolutely false. Many factors that need to be considered. Colleges are in competition for students, and that's absolutely true, but they all have their own criteria. So when my students are doing research on colleges, I say to them, if they're describing you, then that's a good fit. If they're not describing you, you have two choices. Step up to it, or if it's below you, then forget it. But if it's above you, step up to it, or it's not you, and move on to the next college. And making too much money to qualify, that's not always true. As I was discussing with that $150,000 in income, it's kind of a magic number. Having your EFC calculated can confirm what you qualify for. Just be careful of those online softwares because they're not accurate. And what did I say earlier? The net price calculators may not be accurate as well. My students' grades are too low. You know, if students were here, I would say it's financially beneficial. Some colleges will give merit scholarships based on their grades, like Marist, Western New England, a couple of SUNYs in New York. They are test optional, so you don't have to submit your test scores. Your grades are what will give you your merit money, which I think is what they should be getting merit money on, because that's what they do every day. That's truly who that student is. We talked about owning your home. So the private colleges, approximately 400, that require the CSS profile will count the equity in your current home and vacation homes. And colleges that only require the FAFSA do not count the equity in your current home, but will count vacation homes and investment properties held privately. And it is no longer an easy process. So merit scholarships are only for the exceptionally gifted. Well, that depends on the college. So RPI teaches to an SAT score of 1390. LIU teaches to an SAT score of 990 out of the 1600 scale. So if you have a 1250 SAT score, you're golden at LIU. They're loving that 1250 student. RPI's like, yeah, we'll take you and all your money and hope, and if your GPA is sufficient, then they'll accept you. But merit scholarships are truly based on the SATs or ACTs unless the college is test optional. And I've seen a lot of students go up 100 points and get $20,000. And I say to my students, you know, just think of it this way. If you spent 20 hours studying for an SAT over time, and you took multiple SATs, you know, you might spend 10 and 10, and you got a $20,000 scholarship, you just made $1,000 an hour. They're like, oh, that's interesting. And if you get that scholarship for 4 years in a row, basically you made $4,000 an hour. And if you only got $10,000, you just made $500 an hour, which is still not a bad deal. So I always want to empower my students to think of that as money in their pocket, even though it's not physically in their pocket, it's not coming out of their pocket, nor are they paying interest on that money. So there's great savings in that. They build freshman classes in advance, and it's done by all private schools. It's called enrollment management. And the way enrollment management works is they have a chart. And on the chart, they have really strong student, not so strong. Really wealthy family, and a poor family. So this quadrant here, this is the quadrant that gets the free ride. The poor family, really strong student. This quadrant here is the families that get the discount. So you may be very wealthy, but you're still going to get your merit scholarships. Then we have the wealthy family over here, but they don't have a strong student. And if the student qualifies academically to get into the college, they'll take your student and all your money. And then here is the college that, you know, the student is not a strong student and they're poor, so they'll get the Pell Grant, they'll get state grants, and they'll get all that free, you know, free money and a subsidized Stafford loan, but the college is not going to give them any money. And in New York, we have the Chamber of Commerce, the Poughkeepsie Regional Chamber of Commerce, the Dutchess County Regional Chamber of Commerce, and there's a youth leadership, a youth program there. And I went in and I helped the students understand that if they wanted to go to a very expensive school, that number one, colleges do not have to meet need. They do not have to. It's not required. And if they did get all the need, but there was still a gap of $10,000, like this one student did have, I said, okay, who's going to co-sign the loan for you? Wait, I got to get a loan? I said, honey, we have a gap of $10,000. Look at the math. And she had her award letter with her. We went over everything. Mom? No. And I could tell by how much need-based money they got that they were. And I said, Uncle, Aunt? And she just started to cry. She couldn't, she was, well, I'm just going to go. I said, honey, they're not going to let you on campus unless you pay $5,000 of that $10,000. So we have to think about it, you know, futuristically for her. And she ended up going to a community college. And I spoke to her about like last year, and she said actually it was the right thing to do, because she saved a boatload of money and she didn't pay any money for Dutchess Community College because of all the aid she got. And in fact, she says, I feel like I made money because when you get federal monies and state monies, if it's whatever's over the cost of attendance gets paid back to the student. But she can use that for her books. She can use that for transportation. So there are other costs associated with going to a college, even a community college, that are out-of-pocket expenses that she wouldn't have had. So it worked out for her, but the enrollment management is the college saying, okay, we're going to take so many over in this quadrant that qualify educationally because we have to pay our bills. We'll see how this shakes out. We can give 1 or 2 over here, and then this is our discount area. You're going to get a 10% discount, a 15% discount, 20% discount. Last year, PACE gave 2 of my students a 50% discount based on merit alone. So some colleges are more generous than others, and some colleges are more generous year over year. So it's something to be considerate of. 529 plans, you got it covered, great. And if you have 529 plan for all 4 years, it's fantastic. But if not, what is your plan to pay for college? And at this, you know, where you're at now, you don't have the timeline to save with a 529. So you want to be utilizing that. You want to be, you know, that 529 should be dialing down into the more conservative investment program. So you have to be cognizant of that. 2 case studies, Alex and Jamie, a high and a low. Low EFC, high EFC. So they both planned ahead. They selected colleges with the right academic, social, and financial fit. Social is 50% of their success, by the way. A student must feel like they belong on that campus. So you really want to be cognizant of that, and of course, academic and financial. They looked and visited multiple colleges. Sometimes families can't get out of their own way to visit a college. I empower you and implore you to visit colleges. So important. Your student's going to step on campus and be like, I don't want to go here. I don't like it. And you'd be like, we didn't even get out of the car yet. They know. Has anybody experienced that? You're laughing. Yeah, I can see that. Yeah, okay. And that's so important. So you're visiting multiple colleges gives students an understanding of what they like and what they don't like. They got their EFC calculated and or did financial positioning prior. And they waited to choose until all of the evidence was gathered. You know, my students aren't making their final decisions until mid-April, and they're mad at me. But we're utilizing that time to negotiate for more money because now they've gotten enough no's so that they know that they have more merit scholarships to offer. So I asked, actually UConn it was, I was like, so how many kids have said no so far? Because I want to negotiate for more money. And they're like, no. And the yield we were talking about earlier, there's a yield. You know, they might send out 10,000 acceptances. They only have 7,000 spots because they know not all of them are going to say yes. And they want to have more. And I said, well, what if all of them say it? You know, then we put them in hotels. And that's what some colleges have done. But it doesn't happen. They know their system. They've got this fine-tuned, right? And of course, the student improved their SAT or ACT scores, which positioned them for the merit scholarships. So Alex was a low EFC. When Alex's mom hired me, she's like, we don't qualify for anything. We own a business. I said, oh, what do you own? Construction. How's it doing? Not good. Okay, so let's look at those numbers, right? So Alex is actually a very unique case because he had a very strong GPA, very strong SAT. He did what we call the bridge program at Dutchess Community College, where you actually spend your senior year of high school doing freshman year of college. It's called the bridge program. So after we did all the numbers, $6,500 was their final EFC. He got accepted to Cornell University as a sophomore, which is unheard of. They don't do it often, but he got $34,300 in need, an $800 TAP award. Remember, their income was $60,000. It's that $60,000 and more that you start to like not get a lot in the tuition assistance program, but we got something. The federal work study, and I'm putting it in here because Alex was already in college for 1 year and knew how to manage the time of working. So he said, no, I'm gonna take the job, and you know what, we'll put it off the cost of attendance. And then a subsidized Stafford loan because he was a sophomore, so he got $6,500. Remember, freshman year is $55,000, sophomore year is $65,000, and then junior and senior is $75,000. So he got a $6,500 Stafford loan. 43.6, he went to the land grant Cornell, and they paid nothing out of pocket. Now he's in debt, and he's got to work for that. But otherwise, the mom calls me and says, where are you? I said, I'm on my way to the bank. I'm going to Poughkeepsie. She worked in Poughkeepsie. She met me in the parking lot of my bank and hugged and kissed me and cried and said, you were right. I can't believe it. And he is doing amazing. He just got married, and $102,000 in savings and only $21,500 in loans because he took the $75,000 and then the $75,000. So his loans were $21,000 for the land grant at Cornell. So there's 2 Cornells. It's still a Cornell education, but one is subsidized and one is not. So there's about a $20,000 difference between the 2. And he went to it's called CALS. Jamie is a high EFC. So Jamie is my niece. She was that's not her picture. She, she was a strong student, and her parents have vacation home, which I love. Final EFC, $93,000. So that just means that they don't qualify for need. But she did get $18,000, as I was explaining earlier. She got the $18,000. She was originally offered $11,000, and we were able to negotiate for $7,000 more. Unsubsidized Stafford loan, because that $93,000 expected family contribution was much more than the cost of attendance. And so she got $23,500 and $8,000, and I'm talking about out-of-pocket costs. So yes, she has to pay that $5,500 back, but out-of-pocket, my sister had to come up with $20,000. It's less than the price of a SUNY for out-of-pocket. And over 4 years was $72,000 savings. And she actually just started as URI as she's teaching actually, and then getting her master's. So she's doing that, program where you teach and then they pay for your master's. That's another way of paying for masters. So what do you do with savings? You pay tuition for another child or help pay for postgraduate. Those graduate costs are very expensive, and some students actually need to do that next level to get to where they want to go. So let's look at, we're not done. Let's look at the private loans. And again, I implore you, if you are going to debt up your student on any level, start with the Stafford loans. They are a low interest rate loan, and they have a fantastic payment plan. They have income-based repayment. The minimum that you have to pay is $50 a month. They're very workable, if you will. If your student can't afford to pay, there are different payment options. Income-based, pay-as-you-go. There's a graduated payment. So if your initial loan payment is $300 a month, the graduated might knock it down to $150, and then every 2 years you recertify and it'll go up slowly. So at in the 8th, 9th, and 10th year, you're probably going to be paying $600. But while they weren't making a lot of money, sometimes that works. Graduated payment and standard repayment are the two that I suggest, because when you get into income-based repayment and pay-as-you-go, that tends to take the loans out to 25 years, only on if you need to. And there's deferment and forbearance. You guys are laughing. Why? No. Like, did you do that? Okay. So anyway, so you just want to you want to understand those loan options, but if you are going to debt your student up at all, please start with the Stafford loans. And then we get to this. Variable rate on one side and fixed rate on the other. So let's start with the variable rate. When I started my business, variable rate was really all that was available. I'm like, wait a minute, what's the interest rate cap? 25% on the variable side? 25%, wait, what? When we called Ascent on August 26th, they couldn't answer the question. Wait, you don't have an interest rate range or a rate cap? Is there a manager I can talk to? Yep, not available. I'm like, you know what, I'm gonna put a question mark there. Discover is not bad at 12.99. Sallie Mae, 25%. SunTrust, 36% rate cap. And unlike your mortgage, when you have a variable rate mortgage, there are rate caps, do like 2% a month. I mean, they can't even do it, like there might be like a rate cap of up to 16%, but it's collateralized, so it's usually not horribly that high. But my point is that even like regulated, they can't go up more than 2% on the rate increases. This is unsecured debt. So that's why the interest rates are so high. The default rate is astronomical. And there are banks that will stop lending to current students because graduated students are defaulting. It happened to one of my students. She was going to LIM in the city. She got a $15,000 loan with Discover. Her grandfather said, next year, I'm going to pay 10 grand, just get a $5,000 loan. She went back to Discover and said, okay, I only need 5,000. She applied for 5,000. They're like, we're not lending to LIM students anymore. Wait, what? I only want 5,000 this year. I don't even want 15. Nope, sorry. So sometimes the banks back out of lending to that college. So you really want to be cognizant of the rate cap. The only benefit is that the interest rate ranges are a little lower, like you might get a 4 or 5% initial rate. Interest does start from day one, so be aware of that as well. And I had a mom single mom, no mortgage, she owned her condo outright, she was making 60 grand a year, one child, she got a private loan, 10% interest, her credit score was 850 or 840. And they still charged her 10% interest on her student loan for her son. No low debt to income ratio, she didn't have credit cards. She's like, I don't understand. I said, it's unsecured debt. So when you're talking to a bank about what loans are, you know, how their loans work, these are the questions you want to be asking. You know, interest rate increase, monthly, aggregate max borrowing limit, origination fees. Now, common bond is actually my favorite because they don't go over 10%. That's their big, we will not make a loan over 10%. But they have a 2% origination fee. And then how does it work? So yearly or each semester. So a lot of banks want you to do it yearly. So now you're paying 10% on money you don't even have to give the college. You know, if you owe, if your out of pocket is $20,000, you have to give them 10 in fall and 10 in the spring. So if you borrow $20,000, you're not getting a discount from the college to pay them in advance. But then you're paying 10% on $10,000 for 5-6 months that you don't need to be paying. So I prefer my families actually borrow on a semester basis. And if you do have 529 plan money, or any money earmarked for college, exhaust that money first before you take any loans, except for the Stafford loan. Because if you don't have enough money to pay for college in your 529 or investments of wherever you're saving, and you don't have enough, the Stafford loan will stretch out your savings by $27,000. Does that make sense to everybody? So I would only recommend taking the Stafford loan, then exhausting your 529 plan money or any other monies that you have earmarked for college. If you have enough to pay for college in full, then don't take the Stafford loan. Unless you want to put some, your student have some skin in the game, then that's the way to go too. Does that make sense to everybody? Okay. So when we get to the fixed rate side, again, common bond being my favorite because nothing's over 10%, but you can see the interest range rate from 5.3 to 12.07. Discover 13.99, Sallie Mae almost 12%, and Custom Choice with SunTrust 14%. Crazy. Now that'll be a fixed rate though, and I do recommend that my clients do a fixed rate because on the other side, when you have the interest rate ranges of 36%, 25%, or a cent not being able to answer the question, you really don't want that because we are, interest rates have been increasing and our students are going to be in these loans for 10, 15, 20 years, these loans especially. So we really want to use this as a last option. Do the application process on a semester basis. The cosigner release, Discover does not release the cosigner, ever. Where the other colleges will, College Ave is 24 months, Ascent is 24 months. The only thing I like about Sallie Mae is they have a 12-month cosigner release. So that's nice, 12 months, on time payments for that amount of time. You're late one time, cosigner does not get released. So be very careful of that.
What does that mean? I don't know what that means.
So you co-sign for a loan for your child, and once they graduate, they start making payments 6 months after graduation. All loans for student loans, federal or private, have a 6-month grace period. So then in the 4th month, you forgot and it didn't get paid, or your student forgot and it didn't get paid. You no longer will be released as a cosigner. Whereas if you make those on-time payments for 24 months, 36 months, 12 months on time in complete principal and interest as the payments, defined, you will then be released in that amount of time. And if you have student 2, student 3, you really have to be cognizant of what you're detting yourself up with number 1.
What do you mean, for life?
Or for the life of the loan. Until the loan's paid off.
Oh, God.
Yep.
How are you going to follow all these,
Well, you come to a college planning course like this, and I give you the heads up. Okay. As I said, repayment plans, they defer 6 months. You can pay interest only. A lot of the banks now are giving you a little bit lower of an interest rate if you do a monthly payment with them. And I always recommend to my clients, if you're going to borrow from private banks, pay $50 a month towards it, just to offset some of the interest that you're paying. It's very beneficial. And some banks like Sallie Mae require I saw one year $36 a month they required. But that's okay. It's manageable. And then it covers books, computer, tuition, living expenses. The Discover will say whatever the school certifies. And then there are rewards. So if you go into auto pay, they might give you a 0.25% reduction. And if, like this one has a 2% principal reduction if the student graduates with a 3.0 GPA. That's cool. Some incentives there. Then if you look at my footnotes at the bottom, the aggregate maximum borrowing amount will include all student loan debt, including the federal student loans. So they're aware of that. And as I said, in order to have the cosigner release, the payments must be made on time for the consecutive months listed above. Credit score of 760 plus is better. It's how you get the better rates. And if a client has a credit score of 640 or lower, bankruptcies, even 2 or 3 years old, So, and the school you attend could affect your rate. So if the students, as I said, leaving there are defaulting on their loans, then the bank will stop lending to them. So, thank you very much for coming tonight. I appreciate your time. Please fill out the evaluation form, and I am here to answer any questions that did not get answered during the presentation.